Hello everyone and welcome to another episode of All Things Real Estate. As always, I am here with a guest, and today we have a mortgage lender branch manager. We have TJ Curran from Fairway Independent Mortgage, and TJ is a local lender. He's been with some other companies prior to being at Fairway, so he's been in the business for a little while. So TJ, thank you so much for being here.
Thank you for having me.
Absolutely. So TJ, you've been with Fairway for how long?
About 2 years.
Okay, so he's been with Fairway for too long, but you've been in the mortgage business for
about 20 years.
Wow, so that's a lot of experience.
Yeah.
So you have been through, so that's good, because the last couple people that we've had on, similar, been in the business for a while, but what we didn't get into, and I want to get into today is, so being that you've been in the business for 20 years, you've seen the cycles.
Right.
So you've seen the up, you've seen the down.
Yeah.
Right? So now, right, so now where we're at, we're probably at the higher end of the cycle, right?
Right.
So at the end, the tail end. So can you just speak about back in, 08, 09, 10,
Sure.
when things really hit the fan, what was the reason, in your opinion? What was the reason then, and what is the reason now that we won't hit that same, lull or decline?
Sure. It's a great question. So there were a lot of different mortgage products. Basically, you only needed a face and a pulse to get a mortgage back in like 2006, right?
Yeah.
And there was such a large appetite for risky mortgage-related bonds on Wall Street. Mm-hmm. They were being traded at a premium. Mm-hmm. They're making a lot of people at Goldman Sachs and all those other companies very rich. Mm-hmm. And they were betting not only on those bonds, because historically, the prices of houses had never gone up. I mean, never gone down.
Yeah.
So they'd always gone up, 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 up. But they were always gradual. It was kind of like a very safe bet. And what was happening was, in order to satisfy the appetite for the mortgage bonds on Wall Street, mortgage companies were creating, and banks were creating these crazy mortgage products where you didn't need a job, you could state your income, you could do what's called negative AM, meaning you could actually pay less than the minimum payment on your mortgage and just have the negative amortization go against the equity that you're going to find in your house. Mm-hmm. And when that slowed things down, mm-hmm. what they also did was they started inflating artificially the prices or the values of homes. Mm-hmm. So it was like a perfect storm mm-hmm. of all kinds of unethical and also kind of unintentional financial unregulated mess that led to basically the housing crisis of 2008. And what's happened since then is regulations in place, mm-hmm. The Dodd-Frank Act, mm-hmm. and there's TRID, which really kind of makes sure it ensures that banks and lenders aren't lending to customers who can't afford a house, mm-hmm. right? It's called QM. And they're also very strict about the values of the houses and allowing or not allowing people to borrow against the equity in the house.
Right.
So it's a much more solid foundation.
Right.
I do feel like we're headed towards a downturn, just a slower economic cycle, which is, the economy is cyclical, mm-hmm. and we are really in a bubble economy. I don't believe the bubble is going to be real estate this time. It's going to be something else.
So there's another show. The reason why I asked that,
sure.
right? So we've had a couple people on, and some of the questions I've been getting is, hey, so the market's really high.
Right.
We had a bubble in 08, 9, and 10, or 7, whatever, and it crashed, right?
Yeah.
Do I envision the same crash? And my answer is no. And the reason is regulation.
Right.
We had prices that didn't belong where they were, right? We had people that didn't belong buying houses they purchased. So for that reason, the bubble's not the same. So it's interesting. We could have another bubble, but it has a different action-reaction than the last one.
If you remember, the bubble before the real estate bubble was a tech bubble.
Tech bubble,
right? Like Pets.com and all the internet companies that were getting VC money, and they weren't worth anything, right? And they were just being traded for high. I think the bubble's going to be in a different sector. But whenever there is a bubble and the economy turns, almost everything else slows down.
Right.
And for us in housing and real estate, I believe we're just going to level out. There's going to be a plateau. Right. I don't think values are going to go down.
Right.
I don't think you're going to find fewer people buying and selling houses, but that's typical of a downturn. But I don't think values are going to go down. I don't think as many people are going to lose their houses as they did in 2008, 2009.
Right. I don't think foreclosures will spike like they did. I don't think short sales will spike like they did. And I think the important factor there, too, is I think rates may go up, which obviously it's inevitable. At some point, interest rates will rise.
So I agree. I think interest rates will rise. I think we're going to see a downturn in the economy before we see rates go up.
Right.
And usually rates go up with inflation. But because the rest of the world is almost in a negative interest rate environment,
right.
Institutional investors from other nations are now pouring money into our real estate bonds.
Correct.
And that's keeping the real estate, keeping the interest rates low.
Correct. So that's how that action reaction works there as well. So
Right.
more money comes in, rates stay down, prices go up, and it inversely works together.
Yeah.
So that's good because this is why I want to ask you too. So the last downturn or the last kind of result or reason for the downturn also was subprime, which you talked about.
Sure.
Have you seen any subprime lending back in the market now? And if so, is it anywhere like what we saw before?
Okay, so there are mortgage products called non-QM products. We talked about QM.
Right.
It basically,
what does QM mean?
QM, it's quality mortgage, basically. Yeah. It ensures the borrower, there's like a checklist of different steps that have to be taken to ensure the borrower can afford the mortgage that they're getting. Now, non-QM means it doesn't adhere to those standards, but it doesn't necessarily mean it's a bad mortgage. Now, there are mortgages coming back, and they're a lot less widespread. Like I just saw a stated mortgage on a sheet from a wholesale lender. That's not a mortgage that a lot of people are going to want to touch because the toxicity of it, just from past performance, is evident. But there are products for investors, self-employed people who make it a little bit easy. That makes it a little bit easier for them to get mortgages because, frankly, they have the deck stacked against them. If you're taking advantage of all the tax benefits of being self-employed, you show less money on paper than someone who has a W-2.
Right.
And so in the mortgage standard for qualifying for a mortgage is actually higher for those people. And in the non-QM products, it allows you to kind of, it's a tailor-made mortgage for self-employed borrowers. So it's good for that reason.
Which is good. So it's a different reason for what we had in the past for subprime. This is a different reason to help people that can't actually qualify.
Correct.
Give them an opportunity to buy.
Right. And they're also, it requires more of a down payment.
Right.
So there's not going to be
There's
like
more skin
negative.
in the game.
Correct.
So on that non-QM stuff, so not getting too granular, but at the end of the day, I think it's important that people understand, like typically investors needed to put down how much? If I were to buy a 3-family as an investor, how much would I put down?
Typically, for a conventional
regular
mortgage,
conventional
25%.
So 25%. Now,
Correct.
I have seen different products now 15%.
Right.
Even as low as 10%.
Right.
So why is that important? Because when we're at the end of a cycle, something has to hold those values, right?
Right.
So if investors now can buy with less money down, that'll help the value stay up because the demand will still be there.
Right.
Is that kind of what you see in that space?
I do. I see. It's funny. On the way to the studio today, I had a call from someone looking for a 15% down investor product. So the awareness is people are becoming more aware of these products, and there's a larger demand for them. Now, I will say, having gone through everything in 2008, these products, the 15% down, because all mortgages are risk-based, it's a much more difficult product to qualify for than like a stated no-doc mortgage.
Right.
You have to have very good credit. You have to have asset reserves that shows if something happens, you can pay for the rent, lost rent. And you also have to have a debt ratio that's lower than what a standard debt ratio would be on a conventional mortgage.
Which speaks to regulation.
Correct.
Right. So those are, even though those are some not subprime, but they're different they're non-qualifying mortgage products, right? At least the regulation's still there.
Right.
So there's still steps in place to make sure that if these folks don't pay, there's some repercussions. There's something they can go after.
So here's the difference, and this is what I found. At least this is my own personal opinion. Before 2008, institutional investors like Goldman Sachs, Lehman Brothers, Bear Stearns, they were taking out insurance policies against
these loans,
against the mortgage bonds,
the
right?
bonds.
So if for some reason they had a tranche of mortgage bonds that defaulted, they would actually be able to collect insurance money from companies like TIAA, and so they were kind of hedging their bets so that if they would either win with the mortgages, which were risky, so they had a higher yield, or if they didn't perform and they got defaulted on, they would have the insurance policies against it. And what happened was so many of them defaulted at once that it almost brought down the insurance industry as well.
Yeah, that I remember. Some of the companies that insured those bonds almost went out of business.
Correct. They had to be propped up by the government.
There were two specifically, two bigger ones, and they almost literally because I was
TIAA.
TIAA, and the other one began with an A, and I can't remember the name of it, but yeah, those companies almost were bankrupt.
Right.
So the government stepped in. So the point of all that, right? In summary, I think we both agree that we are in a bubble. We both agree we're at the end of a cycle.
Right.
But that the downturn is not going to be as drastic. That stability will remain with pricing. That we've
because it's not going to be a real estate bubble.
Correct. It'll be a bubble in another economic area.
Right.
And what that is, we don't know.
Correct.
Right. Presidential election coming up. We have all these different factors.
Right.
We don't know what shoe will drop.
It's probably
student loans.
It's going to be it could be student loans, although those I don't see a high percentage of defaults on those because you can't get away from them.
I know.
Right. You can't put them into a bankruptcy. They're just on there. They're with you forever. Right. But what I do think it's going to be some sector of the stock market.
Yeah.
So it's going to be insulated from the rest of the stock market.
Right.
So it's not going to be as bad.
Right.
But it's going to be a cycle, and it's not going to affect real estate values. It'll affect people like you and I because there'll be fewer customers looking to buy and sell. But for the lay person out there in Seekonk, it's not going to affect their day-to-day life.
Right, and I think especially here, so the bigger bubbles that will probably see more drastic change in price, your Bostons, New York, LA.
Correct. You're already seeing those.
Right, so that's already happened.
Right.
Here, I don't think we're going to see as big of a I would say the values in some of these things may be 10% off, 5% off what they should be, but you're not going to see a 50% drop.
Here's a reason, in Rhode Island especially, and in areas in Massachusetts, there's such a demand for housing.
Right.
It's supply and demand.
Right.
There's not enough supply, so the price isn't going to go down very much.
Right.
If there was an oversupply, or the price had completely outpaced the demand, you'd see a fallback. But because there's such a shortage of housing, and there aren't a large number of housing starts, meaning new construction, prices are going to be stable.
And that's a problem in Rhode Island specifically. Housing starts are way low. So Rhode Island, I believe the median price of a house is $261.
Right.
Do you know Mass?
I don't.
I don't know either. But
I believe it's got to be higher. It's probably
in the
probably 305 or something like that.
Probably in the threes.
Yeah.
Low 3 to mid 3. So those values are pretty fair, I would say, for all the cities around. That makes sense to me. Right?
I agree.
The only place I'm starting to see things not make sense are the multifamilies.
Right.
So the average 3-family in Providence right now, I would say is 275 to, and this is just off of me kind of being in that space, 275 to 300. That's a lot higher than what I've seen in the past 5 years.
Right.
So that's really taken off, right? And I think that's the space where we might see a little downturn.
Again, supply and demand.
Right. Correct.
Right.
There's nothing to buy.
Right.
So these people are bidding these properties up.
Right.
So I think the good news is we have the same outlook there. The good news is, guys, we're not in for a major crash. Prices should stabilize. Demand will go down a little bit. Supply, who knows? We don't know where supply will go.
Right.
But if supply increases and demand goes down, the prices will go down automatically. It's just inevitable.
There's got to be an incentive, especially in Rhode Island. The government has to create an incentive for builders to build.
Right, and there's not.
There's not.
Right.
Right now, what they're doing is they're giving incentives for landlords for buildings that already exist.
Right.
And usually it's the landlords that don't need the incentive.
Correct.
And it's not,
And the other incentive in Mass and Rhode Island is Mass housing and Rhode Island housing.
Right.
Right. So those are for first-time buyers. So there's good incentive still for a first-time buyer.
For buyers, right.
For buyers.
Not for builders.
Right.
Right.
So on the buyer side, right, the incentives there, the millennials, the talk's been that millennials would rather rent than buy. I don't know if I believe that. I believe it okay in some cities, but I don't believe it here. I think people out in these areas are still going to buy at some point, maybe a little later in life.
I think nationally for millennials, that's true because that generation tends to be a little bit more transient, where they're not going to be in the same job for their whole career.
Right.
They're not going to be in the same place their whole career. They're going to live in multiple different places. But I find that especially in Rhode Island and in New England, people end up staying where they grew up.
Agreed.
It's much. They stay regionally much at a higher percentage than anywhere else in the country. So again, we're kind of
and
different than
those people here. So isolate that to New England, right? They're going to buy at some point.
Right.
Maybe not right away. Maybe
Right.
not 20 to 28.
Right.
But in their 30s, they're going to have to buy something.
Yeah,
When they start having families, they have kids, whatever that looks like.
just from an economic
It
standpoint,
doesn't make sense.
It doesn't make sense to not own because you can be an owner for as much or less than what you're paying for rent.
Right.
And it just doesn't make the tax benefit. There's all these other things. I mean, if you're a single person, you're more attractive to someone,
Right.
a potential,
Right.
partner to if you're an owner versus a renter.
Correct.
So there's a lot. You're more attractive to employers. There's a whole bunch of things. Yeah.
No, for sure. So you've been with Fairway for 2 years.
Right.
You guys do Massachusetts and Rhode Island, right?
I'm licensed in Massachusetts, Rhode Island, Connecticut, and Florida.
Connecticut and Florida. So
Yeah.
4 states.
Correct.
The good news, 3 of the states are right around here.
Right.
What would you say? So where we are now, obviously we're in Seekonk, we're in the studio. The average price here, I would say, in Seekonk ranges from $350 to $600.
Right.
Right. I'd say that's your range on average.
Right.
So what products do you guys offer that you would say is most beneficial to people in those price ranges?
Sure. So I find that the people in Seekonk, hey Seekonk, how you doing? is they're going to be the regular vanilla 30-year fixed mortgages.
Yeah.
So there are other mortgage products. You could get an adjustable rate mortgage. Rates are so historically low right now that it's not worth gambling for the extra 0.3%.
It makes no sense.
It makes no sense
to do
right?
adjustable.
We're locking people in on jumbo mortgages at 3.5% today. And you have to have good credit and everything else. But I just locked someone in yesterday at 3.5% on a jumbo mortgage.
All right, so
Yeah.
good question. So a
So
jumbo.
it's a 30-year fixed. Yeah, 0
So
points.
explain to people. So because some people aren't gonna know what that is.
Sure.
So we talked about on the show prior. We talked about conventional. We've talked about FHA.
Right.
We've talked about Rhode Island housing. I'm glad you brought up jumbo. We have not discussed it.
Yeah.
What is it? Explain to me, what is a jumbo mortgage?
Sure.
What are the limits, and how does it help me if I'm a buyer?
Sure. Okay. So here's the thing, and this is probably the only area where the mortgage crash helped buyers from a standpoint of availability and qualifying. So if you have a mortgage that's above $484,350, not sure why they make that weird number, but
A mortgage, not a purchase price.
not a purchase
so
price.
The mortgage. Yeah.
Mortgage is above $484,350. It's called a jumbo mortgage, and what that means is Fannie Mae, Freddie Mac, FHA won't buy that mortgage. So you're not able to sell it on the secondary market in tranches with these other mortgage bonds. Basically, you're looking for it's going to be a private wholesale lender who's going to lend to those. So what's happened is since the mortgage crash, there's been a lot of companies who just service that segment. And their thought behind it is these people can afford to live in this house. They have to qualify based on credit, debt ratio, but they're less likely to default on their mortgage because they have the income to sustain that mortgage. So they're less of a risk, and because we talked about before, mortgages are risk-based, they're going to have access to lower rates even than conventional mortgages.
So, all right, so I'm a buyer. I'm buying a $600,000 house.
Right.
I want to say, TJ, I want a jumbo mortgage.
Right.
How much do I put down?
You can put down as little as 10%.
So 10% of 660,000.
Right.
So I put down 60,000.
Right.
Now my mortgage is on 540.
Correct.
Right. Now, can I pay that off? Is there a prepayment penalty?
No. So most companies have done away with prepayment penalties.
Right.
So-
Especially on residential. I don't
Correct.
see that very often.
Correct.
Commercial, I see it all the time.
Right.
Every commercial loan goes 5, 4, 3, 2, 1
Right.
percentage-wise and escalates down.
Right.
So no prepayment, 10% down. I can hit the principal faster if I want. I can refinance as I get down if conventional if I want.
Right.
I can basically do whatever I want with that product.
It's a regular mortgage. It's just a higher price point.
Higher price point, higher debt level
So
than
correct.
conventional, right?
Correct.
Instead of putting the 20% down, I'm putting 10% down.
Right. So Fannie Mae and Freddie Mac are both semi-government entities.
Right,
FHA's
correct.
government,
Quasi-
VA's.
Right.
So they put caps based on the median income
Right.
of the area. And they put, okay, so this person, median income's this, they can afford this. That's where the 484 number.
Right, because that number varies. That's not the same in Boston.
Correct.
That jumbo in Boston is going to be probably much higher.
Correct. It's going to be, I think, over 560. From the top
Right,
of my
so
head.
that's a difference.
Right.
So this
Hawaii's the same. Like there's
New
area
York,
California.
LA,
Right,
all those
right.
things are probably all different.
Right.
So this is good. So this is a product that we can educate people on that we haven't talked about, we didn't know about.
Right.
So I'm going to totally go off on a tangent now. So
Sure.
you and I have been in a relationship here for about a year now
Right.
with the radio show.
Correct.
Right. So
We have a radio show on WPRO.
Right. So go
called
ahead.
Give Me Shelter.
Yep,
Yeah.
So go ahead. You started it. It's your radio show.
Right.
I'm the co-host. You're the host.
Okay.
It's on
Right.
WP.
We started together though.
Right.
Yeah.
We did start together.
Right.
So we worked on it together.
Right.
But I think that transformed into a nice program. And I
Right.
think this is an example. I wanted to have you on early on because I wanted to explain how this is an example of what we do on the show.
I appreciate you getting warmed up with the other lenders,
Right.
so you could work out the kinks on the show, and you could be perfect for when you had me on. I appreciate
We've
that.
only had one other.
Right, okay,
So you're
okay.
okay. You're okay.
Okay.
And I had to scramble, but you're okay. So our show, right, it's on WPRO.
Correct.
Right. It's on either Sundays at 1
Right.
or
If there's a Patriots game,
if
it's
there's a Patriots
Saturdays
game
at 5.
Saturday at 5.
Right.
So just to confirm that, because I don't think so if the Patriots play at 4, it's still
There's
at
still no show. It's
right.
on a Saturday.
All right, so it's automatically Saturday.
So the Patriots play Saturday during the day at all.
Sunday during the day
at all.
is
It's
always
on
on
Saturday
Saturday.
evening. Yeah.
So it's on Saturday.
Right.
It's 1 hour,
Right.
right? We have a guest on here and there. Typically, we'll have a guest. If not, it'll be just you and I going back and forth, talking about the market, kind of what we see, what we've been through,
Right.
experiences.
Anecdotes about experiences we've
Yeah.
had, because we both do enough business that we can
Right.
bring up a story.
Right, and the
Yeah.
good news there is you get the lending side.
Right.
I get the buyer-seller side.
Right.
Those two things can be different, but have the same goal at the end of the day.
Right.
So that show, I think, has been helpful for me. It's been helpful for you and
And I
the
hope
audience.
it's been helpful for the audience.
Yeah, I think the audience
Yeah.
has been great, and I'm hoping that people that watch this can tune in and kind of get this same sort of education.
It's a deeper dive than what this is.
Deeper
Yeah,
dive, and
right.
it's a value.
Right.
Right. So for someone just looking for value on real estate, I think it's different than some of the other shows.
I agree.
We get some good viewership, some good listeners, some good calls off the shows.
Right.
So I think it's been helpful, and I think this show is a very basic introduction to different things within real estate. That's why it's called All Things Real Estate.
Right.
So I thought the two things went hand in hand, and I think it's important that people know.
Yeah, no, I think it's great. And I think it's great that you're putting out so much content, because it's funny, people in general don't know what questions they have until they have them.
Correct.
So putting content out there that's value add, it's not sales front forward, right?
No.
We're not trying to sell anyone anything. We're just giving out information. That can generate other questions. That can generate, maybe some people have the confidence then to move forward, and maybe they didn't know they had the ability to buy a house, or maybe they didn't know it was a good time to sell a house, and it just puts the power in their hands to go in and make it an informed decision.
Right.
Yeah.
And they put a name. So let's just say they do have a question, right?
Right.
So now you've heard me, saw you, heard you.
Right.
They have a name and a face to that person behind the sign,
Yeah.
or that person behind the business card.
Right.
So it shows that we're approachable.
Yeah.
You can come to us.
Yeah.
Talk to us.
And I apologize that the face isn't as good as the voice.
That's why we both do radio.
That's why we started radio.
We
Yeah.
started radio.
Right.
So in the essence of time, do you have any closing remarks? Anything you'd like to say? Anything you'd like to share?
We're already done.
We're almost done.
Oh, okay.
We're almost
All right.
done. Yeah.
I would just say almost every single millionaire in the country has become a millionaire through real estate. It is a stepping stone to financial independence, but also there's rewards for just owning your house and having pride of home ownership, right? And if there are questions or you have any doubts, hopefully they can put my name and phone number on the screen,
Well,
and
you can
people
give it
can
right
reach
now.
out to me.
You can give it right now.
So my phone number is 401-258-8523, and you can reach me anytime. And I'm happy to answer questions because, like I said before, having your questions answered, having some knowledge about really what is a scary endeavor for a lot of people can help you make that first step.
Right, because people don't buy and sell every day.
Right.
And that's
Right.
what it comes down to.
Right. Because even if you bought your house 10 years ago, it's completely different
change.
now.
Things
It's
totally change.
completely different now. You know, so it's different, and having someone like yourself who's able to provide value and just has so much experience in the market is a really it's a powerful tool.
Mm-hmm.
Yeah.
No, I agree, and I think that's great, and that really winds this show down, and I appreciate it, and thank you so much for coming out. It was my pleasure.
No, thanks for having me.
No
I appreciate
problem.
it.